Hello, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is Spotting the Trade. I'm going to get you what you need to know before you go, and that's going to start out with the economic data, see how that's impacting the overall markets, maybe sprinkle in some geopolitical fodder to round off that market analysis, and then we'll finally end up with some option strategies that we might be able to implement into our portfolios based on those assumptions we come up with. All right, so further ado, across the pond, we got economic data. That was the PMI, Purchasing Managers Index. You guys know I love looking at this number because it's forward-looking. Well, this is the revision to the flash estimates that we get. Those are the ones that we really look at. Those are the precursor to this number. This is when they kind of round out all the numbers. All of them coming in above 50, which is expansion in the economy. That's good. We want to see all these numbers coming in above 50 right now. One thing we got here in the United States was the non-farm payrolls. Remember, this is Unemployment Friday, or Unenjoyment Friday, as we called it on the floor. Well, that number coming in at 331,000 hires, expected to be 492. That's a miss, pretty big miss actually. But the revision on the backside probably makes up for that. The revision on the backside was about 70,000, so that rounds off this number to being in line, if you will. Not going to probably be a market making or market moving kind of number. The unemployment rate did downtick to 3.6% from 3.7%. Now, what is going on with the levers and pulleys here? We're seeing people not look for jobs. We're seeing the unemployment rate fall. Well, there's a couple of things going on here. We talk about the labor force participation rate. You're going to hear a lot about that today, probably, as folks are talking back and forth. With this unemployment number, the way that the rate is coming down, it's a product of folks that are either in the labor force, that are actively hired, folks that are looking for a job, or people that are on unemployment. So to be part of the statistic, you have to actually be looking. Now, we call this a discouraged worker, where they've looked for a job for quite some time. So they might not have been able to find it. So they're discouraged at this point and they stop looking. They fall off of the labor force participation rate. That's what we've seen historically when we're talking about this labor force participation rate. Now, we're just coming out of this pandemic where folks were getting money and all sorts of things that changed the dynamic of people not working. And in the thought process of people really wanting to go back to work, and the isolation and getting back into society is a real struggle for some people. So those folks are falling off of the labor force participation rate, and that's making it look like people are employed when they're just in fact not looking anymore. All right. So once those folks start coming back into that labor force participation rate, it's going to juke up that number a little bit. And that's what we're seeing here overarching with some of that, is that folks are saying, hey, yes, the employment number, the stats look pretty good, but we know that we're struggling to get folks back into the workforce. That's driving wages higher, and that's causing a lot of turmoil in the markets, really. So with that said, let's get on with checking out the markets and see what's going on there. We've got crude oil here coming off, and this has been all of this tension between Russia and Ukraine, and there's still Russian oil coming here. Are we going to accept that it's supposed to be here at the end of May or something like that? So that oil started leaving before all these sanctions started happening. So that oil is still in transit and in flux as to whether or not we're going to accept it for the most part. But so the market started coming off on the release of the oil reserves. It's 1 million barrels a day over the course of the next several days. But folks, that's not going to be enough to really make up for the deficit of all of these folks not fracking. There's the way to really get oil prices to come back is to allow all of these permits that folks have pulled to start producing oil, to allow them to actually start producing it here in the United States. So crude oil is coming off basically on the oil reserve release. I don't think that's going to be enough to sustain a bearish turn really in crude oil right now, especially with the manufacturing numbers we just talked about. PMI all above 50. That is expansion. They are the biggest consumer of crude oil products, whether it's for polypropylene, for plastics and things like that. All of those things are going to be things that go into the manufacturing sector. That is demand for that. I don't think that crude oil is going to be able to really get into a bearish trend right now. Bonds, we saw a yield curve inversion. We talked about that yesterday. It's inverted as of right now, or as of the last I checked. That is a signal of a recession, folks. That's when short-term interest rates start jacking up versus long-term interest rates. And we start seeing that, hey, in the near term, we're looking at higher interest rates, but down the road here a little bit, we're looking at lower interest rates, which means we're kind of speculating 2-3 years or, 2-3 years in advance that, hey, the economy is not going to be looking very good in a year or two. So bonds really are in flux right now. Some folks are saying interest rates are going to rise 50 basis points at a crack. Well, yeah, but then they might have to turn around and start cutting at 50 basis points at a crack. Now, gold futures coming off a little bit, inflationary worries, that's going to be the thing that drives this. Now, I'm looking at getting long in gold futures through GLD. I talked about this in the webinar yesterday on how to build a poor man's covered call, limited risk to the downside, to be able to take advantage of that upside. You're capping it at the covered call area around the 16 delta. So pretty good wiggle room there for the upside win, but not looking so great right now. Bitcoin and gold seem to be inversely related almost these days. VIX, VIX isn't giving us much of an indication in the past, and we've been seeing VIX come off a little bit here with the market starting to correct. So VIX isn't totally concerned about downside here. It is, I think we're getting used to some of this volatility in the markets in and around these points of controls that I've been talking about. Like the now I've got marbles in my mouth today. Sorry, folks. The NASDAQ here, I had a nice big rally punch through these old trend channels. But the thing is, I talked about this, all of this mess that's going on right now is around the point of control. That's where everybody's transacted. So there's no real interest to get involved at prices that we've constantly seen over and over again. So while we see these rips and dips, it's really just kind of vacuums popping and dropping here around these points of control. And I talked about this. It's nothing to really get too worked up about. The fact of the matter is, when we get these rips, that's when we need to look at doing covered calls in our portfolio right now. And on the real big pullbacks, we look at selling some puts to add stock to our portfolio that way. That way we get into a mindset of portfolio management, really, rather than just trying to trade around these choppy markets. I would stay away from trading on those choppy markets. Tuck those hands under your butts and look for covered call strategies around things that you already own. Dow Jones Industrial Average, where is it? Right at the point of control, folks. We broke out a little bit to the upside, but look, we're right back down to it. E-mini S&Ps are the ones that have extended, and I talked about the product of them wanting to rally, and maybe even the Dow Jones Industrial Average getting more of upside, longer duration upside here, as folks are going to really be concerned about adding value to their portfolios and not really trying to get after the tech sector. We've seen the FANGs not do very well recently, and I talked about that. That's what was going to start selling off first. We were going to see that influx into the Dow Jones blue chips here and get a pop on that. Now, some of that has worked out, right? More of it was that money being allocated to E-mini S&Ps. People are still looking for that risk then. That's what that's telling me, with the E-mini S&Ps outpacing the Dow Jones, the upside, is folks are still seeking some risk here. But all of that said, risk still to the downside here, especially heading into a weekend. Now, yes, I've said for the last 3 Fridays probably that, hey, I would still be concerned about the downside. And what happened? We got a little bit upside there. More of that was happening, the correction on Mondays, which is a little bit bizarre to me. I would still be concerned about risk to the downside on a Friday heading into all this turmoil that we have over across the pond, right, folks? So looking for covered call strategies on the rips, pullbacks, looking for selling some puts, adding underlying to our portfolio. And if we don't put the stock, then hey, folks, we just got a free dividend, if you will. And I show how you build those strategies out in these webinars. So please make sure you guys are smashing that like button. Don't forget to subscribe with the little bell, because the bell lets you know when I'm unannounced, right? And if you can't take that, take it easy. Have a good weekend, folks.